Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest and one of my most favorite people to interview. Also, he's widely requested all the time. Everyone wants him back on every couple months for his analysis on commodities, mining stocks, precious metal royalty, and streaming companies. He has decades of experience in the industry, both as a credit analyst looking at the balance sheets, financial statements of these mining stocks and oil and natural gas companies. He worked on Wall Street in the past. He ran his own firm that was investing in these companies. He is a mine financier. He's helped build hundreds of mines, looking at their financial statements, bringing them into production, hopefully to generate free cash flow. He also was the former vice president over at Sprott. Rick Roll, thank you for joining me again.
Always a pleasure, Jason. Thank you for having me back.
So, Rick, we're recording this interview on Wednesday, January 15th, 2025. The gold price has held up very, very well lately, the US dollar gold price. It's been well above $2,600 for a while now, for months in a trading range. It popped, I think, today a little bit above 2,700. It's a little bit below 2,700 when we're recording this interview. I want to get your thoughts, though, on the divergence between the gold price and the gold miners' valuations. Because when I look at the GDX, which is the gold miners ETF, and I just pulled up on one of the max charts. It's at around $36 on the GDX. That's almost $36.72. That's almost 50% below the all-time high for the GDX back in 2011. And yet here we are, Rick. The gold price is much, much higher than it was in 2011. Why do you think there's a huge valuation discrepancy between the gold price and the gold stocks?
Let's first of all reiterate the fact that there is a discrepancy. This isn't a matter of conjecture. The enterprise value, the collective enterprise value of the major gold stocks is substantially below historic norms relative to things like free cash flow and balance sheet strength. So let's acknowledge, first of all, that the circumstance that you describe isn't narrative, but in fact, statistically is real. Let's talk about why. In the first instance, an awful lot of the strength in the gold price is due to central bank buying. So the buyers that cause the gold price to go up are not people who buy gold stocks. Central bank buyers buy gold, not gold stocks. So the first part of the delta between the gold price and the valuations of gold stocks has to do with the fact that while the markets are related, they appeal occasionally to different constituencies. And one of those occasions is now. If we look back at the last 3 or 4 years of gold price strength, what we see is a decided lack of Western world, which is to say European, Australian, or North American retail buying in gold stocks. If we look at the flow of funds into physical ETFs, things like GLD and SLV, what we see is that in the past 40 or 45 months, there have only been 9 months of positive net flows, statistical proof that Western world retail isn't in the gold market. And given that Western world retail and institutional is the stuff of the gold stock market, the absence of a buyer in one and the presence of a buyer in the other explains an awful lot of the divergence in their fortunes. But I think the circumstance goes deeper than this, Jason. You mentioned 2011, which is useful for my next point. In the decade 2000 to 2010, the gold price escalated sevenfold over that 10 years. And the free cash flow per share of the Philadelphia Gold and Silver Stock Index actually fell. Excessive dilution. Stupid investment decisions, stupid mergers and acquisitions meant that the gold mining industry actually had reduced cash flow per share in a decade where the selling price of their product increased sevenfold. Veteran mining industry investors, and certainly generalist investors, looked at that putrid track record and thought, are gold stocks really leveraged proxies for the gold price, or are they collections of clown managers that can mismanage a sevenfold increase in the selling price of the commodity? The third thing to consider is that in the last 4 years, while the gold price, or maybe 3 years, where the gold price has increased at a faster pace than it had for the last 20 years, the price or the cost of inputs to produce gold has increased too. So the margins that producers have enjoyed or that people would have expected them to enjoy in the face of an increase in the gold price from, say, $1,700 to $2,700 has been more muted than people expected because of the incredible inflation of things like skilled labor, of construction costs, and in particular, the incredible inflation in the social take for mining, taxes, royalty, and off concession investments by mining companies required by governments. It has just been in the last 2 quarters, really, that the industry has seen the increases in gold pace in the gold price outpace the increases that we have seen in input costs. And the consequence of that is that we've seen the more efficient producers, say the Agnico Eagles, say the Alamoses, see the Lundin Golds, not merely beat quarterly earnings estimates, but absolutely obliterate them. To the extent that this performance continues on from the best of the best to the rest, I think that you will begin to see, Jason, the incredible disparity that you correctly talked about between the gold price and the share performance of the bigger and better gold stocks, as is evidenced by the XAU.
Let me add to your points there. Also, the retail investment demand that has exploded the last 14, 15 months out of Asia for China, India, Japan, Korea, Thailand, Vietnam, pension funds there, they're not buying gold mining stocks. So they're not even buying the Chinese gold mining stocks. They're not buying Newmont Mining or Barrick Gold. They're not buying a basket of mining stocks. They're not even buying Franco-Nevada. They're just buying physical metal or these physical gold and silver, or these exchange traded funds that supposedly have metal. So they're not buying the gold stocks. Like you said, the Asian retail investor wants actual metal.
Correct. And in certain Asian countries, like China as an example, the Chinese state is encouraging individual savers to save in gold. They are facilitating those transactions. They are not either facilitating or encouraging the purchase of gold equities, but rather physical gold itself, as you've noted.
So you mentioned three of the lowest cost gold miners. Now, if you're running Agnico Eagle, you're running these cash flow valuation metrics. You have good free cash flow. Now you have $1,000 an ounce or more free cash flow margins for some of these low cost gold miners. You're going to start to look at mergers and acquisitions, right, Rick? You're going to start to say these other assets, I can buy them so cheap. I'm going to go start buying assets right now.
In the particular case of Agnico Eagle, their development pipeline is so strong that they're in a lovely position. They can grow without M&A. They will use M&A where they see strategic fits or where they can add free cash flow cheaper by buying it than, in fact, by building it. Agnico Eagle, I recently had the good fortune to have lunch with Sean Penn, former CEO and current chairman of Agnico Eagle, and arguably the person as responsible as any for the 2 decade success of that company. And he painted a really, really, really glowing picture. And he did it out of the company's annual report, which was helpful. He said to me that the company's strengths are really mine construction and operation in very cold terrains, in effect, polar terrains, and in fact, in Ontario and Quebec. And to the extent that there was going to be external growth, which is to say M&A, that it would be increasingly around the company's core competencies, that they wouldn't buy production or opportunities that weren't synergistic with their existing operations and their existing competencies. Now, there's an awful lot of room for them to do transactions in Northern Europe or for them to do transactions in Ontario and Quebec. But understand that they're in the unique place that they have plenty of development opportunities within their existing corporate veil without having to resort to M&A. In other words, M&A is something they get to do. It's not something that they have to do.
Okay, so they can be more selective. They can target specific assets or companies. And then if the gold mining valuations continue to be mispriced or this huge divergence, as we were talking about a couple of minutes ago, then they can just wait patiently until they get the valuation. Didn't they just, correct me if I'm wrong, didn't they just go and buy a large land package from a junior miner for around $100 million right around the Canadian Malartic producing mine?
Correct. Correct. And I think that you'll see them particularly active in the Abitibi, in Ontario and Quebec. Uh, Sean has pointed out to me that Agnico Eagle's exposure to gold in the Abitibi is as great as either Newmont or Barrick's exposure to gold individually in the Carlin Trend in Nevada. And so while the aggregate remaining endowment in Ontario and Quebec may not be as large as Northern Nevada, if you combine those two companies, on an individual basis, the holdings of Agnico Eagle in Ontario and Quebec on an enterprise basis rival those of Barrick and Newmont in Nevada. It speaks an awful lot to the potential operating synergies that Agnico Eagle would have with their operating infrastructure and their milling infrastructure and their ability to consolidate either bigger or smaller players in the space.
And Agnico doesn't have the cost creep that Newmont Mining and Barrick Gold have been having because the last couple of years, I mean, Newmont Mining, Barrick Gold, it seems like their costs, Rick, are going up almost every couple of months now, like 20, 30, 40, $50. It's really pissing off a lot of those generalist investors that you were talking about because they see that the costs keep rising.
One needs to look at cost creep, and I'm not casting dispersions on Barrick or Newmont, but one needs to look at the cost creep that has occurred in the last 2 years and ask whether or not that isn't a consequence of high grading in prior periods. High grading, for the listeners who don't know, is where mining companies during periods of low gold prices concentrate their mining efforts on parts of the ore body that have higher than average grade. You can determine that by looking at the company's annual report in the notes and noting, which the companies must require, the average grade of tons produced during the reporting period in contrast to the average grade of the deposit that will be mined over its lifetime. If the if the uh, if the grade mined during a reporting period is substantially in excess of the average grade to be mined over the life of the mine, it may well it may very well be high grading. It may simply be that the company's capital expenditures or sustaining capital expenditures has meant that the correct place to sequence mine operations is in an area that is coincidentally of greater than average grade. But much more commonly, during periods of gold prices, in order to produce for cash, mining companies high grade. They produce high concentrations first. What that means is that in subsequent periods, their mining costs are the same, but the revenue that they generate is less, which leads to cost creep. And one wonders whether or not the stubbornly high and stubbornly increasing costs of mining today aren't due, in many circumstances, to unreported high grading in the past.
That's very interesting. For our listeners out there who are new to gold and silver, during the bear market, when things were dire in like 2015 and 16, and I was getting emails and phone calls and text messages, is Pan American Silver going to go bankrupt? Is Wheaton Precious Metals going to go bankrupt? The silver price was, I think, headed below $15. People were panicking. There were rumors that like almost all the miners were high grading out of desperation to survive. So that was like high grading out of desperation. You're seeing though the last couple of years that was high grading for profit margins to hide some of the costs that were already. It wasn't out of desperation then like during
Well,
2015 bear market.
perhaps what you're seeing, Jason, is, and I'm not saying that this is true, in the period 2015 to 2020, companies high graded. The consequence of that is that their sustaining capital investments need to be higher now, and that their production cost is higher because their production costs have stayed the same while their grade has fallen. That's all I'm saying.
Okay.
Uh,
So
it, High
is there any
grading,
way to fix this?
no,
Is there any way for Newmont
no.
Mining or Barrickle to get up to, let's say, $1,000 an ounce free cash flow margins like a Agnico Eagle or a Lundin Gold? Are they going to be able to fix this then in the next couple of years and start winning back the trust of these generalist investors?
I think that their margins will increase because I think the gold price will increase. I think that the uh, operating cost input escalation will be less profound in the future than it's been in the past. Remember that in 2020, 2021, the oil price was $30 a barrel. Now the oil price is approaching $80 a barrel. That input uh, increase wasn't the fault of the oil company, nor was the increases in steel cost or cement cost or labor cost, or particularly the government take. On a global basis, the government take in mining on a global basis, the escalation in that has exceeded 20% per annum. That's beyond the mining industry's control. In the case of both Newmont and Barrick, there are allegations, I can't substantiate them, that both companies, perhaps by mutual agreement, deferred sustaining capital investments in the Northern Nevada Goldfields operation. And the consequence of deferring sustaining capital investments means that your ability to produce becomes constrained in the out years. You become range bound. You're mining too few faces. Your ability to access and egress faces is constrained because you didn't invest on a timely basis. Perhaps you didn't do uh, pit pushbacks or laybacks as aggressively as you should. And as a consequence, you're becoming slope controlled. If that's the case, and if these sustaining capital uh, deficits are made up, then you should see the operating margins begin to increase substantially.
Now, you've talked about some of the assets that Newmont had up for sale the last 12 to 18 months, like Eleanor and some of the others. Do you think that Newmont Mining got a good price for them? And do you think that the companies that bought them, which was, I think, a UK listed private miner, I'm not sure they're publicly traded in on the London
Yeah.
Stock Exchange, and then SSR Mining got the Cripple Creek mine, 170,000 ounces of gold production. Do you think that SSR Mining got a good deal there on a 170,000 ounce per year producing mine that Newmont Mining shareholders did not benefit from?
No, I think Newmont got a very full price. Whether or not the people who acquired those mines also got a good price will be a function of whether these smaller miners are in fact more nimble and are able to shower sufficient love and attention on the asset and sufficient capital uh, that they can work magic that Newmont couldn't work. One thing I will say for about Newmont is that they had grown to be a company that was operating too many assets. The head office G&A in Denver was too high. One could argue it had to be because of so many assets to oversee, but the fact was that they couldn't lavish the love, care, and attention on a few assets that they should have because they had too many assets. They sold enough assets at a higher price that they exceeded by a substantial amount the amount of money that they would realize from the sales of those assets. And they have been able to reduce debt on the balance sheet, or at least net debt on the balance sheet, at a rate that was much greater than I had anticipated. The question now, Jason, will be where do they go from here? In other words, what price will they receive for the rest of the assets? It will also be whether the substantial reduction in mines that they operate will allow them to reduce head office G&A while simultaneously allowing them to affect the existing assets with much more love, care, and attention than they would have now that they manage fewer assets. and whether they will increase the pace of sustaining capital investments in their high impact operations, given the fact that they were budget constrained in the period 2015 to 2020, both by having too many operations while simultaneously being burdened at that period of time with low gold prices. In a circumstance now where the gold prices are higher, and where there are fewer operations to manage while similarly having fewer operations to invest sustaining capital in, the chance that Newmont has to substantially increase the efficiency of its existing operations with their newly rejuvenated balance sheet is very high.
I can't imagine trying to run a mining company that's producing almost 5 million ounces a year of gold and a lot of copper. It just sounds like a lot of moving parts, very inefficient. But you brought up some interesting points there. The management team has to try to balance a somewhat diversified portfolio of mining assets versus capital allocation, being efficient with that, reinvesting into the mine, making sure that they extend the reserves, they maintain costs, maintain the same amount of costs, or figure out ways to lower costs, or increase the reserves through some type of exploration drilling. That's a lot when you own 170,000 ounce mine. Newmont's so big, 170,000 ounces per year gold mine is tiny for them now.
It absolutely doesn't matter to them. And they made the right decision. 170,000 ounce producer sold to somebody like SSR or Orla or somebody like that makes a material difference. Actually, buying it probably lowers their cost of capital, ironically, because single mine producers in the market trade at lower multiples than multi-asset producers. So a single mine producer that that is acquired by a multi-asset producer automatically loses that discount. Whether or not the smaller companies will have access to the specific expertise required to maximize the value of that asset relative to Newmont is a different question. There have been companies that have done a very good job of that in the past. And my hope is that every disposition that Newmont has made will benefit both Newmont and the acquirer in a win-win circumstance. Of course, that's probably too much to ask for.
Now that the gold price has been above 2,500 for 10 months, do you think that we're going to start to see more, I don't know, marginal gold mines that maybe are not necessarily lower cost? Say they're in the kind of in the middle there, in the median average there for cost projections. Do you think we're going to start to see full funding for those, and those mines are going to get built in the next year or two? They're going to get funding at least and start construction as long as the gold price doesn't crash.
I do. I also think that you'll see more mergers and acquisitions involving marginal projects for the single reason the single asset producers sell at a discount to multiple asset producers. And if the discount doesn't disappear in the market, the multiple asset producers with a lower cost of capital will take over the single asset producers and eliminate that discount. You saw the acquisition very recently of a very, very, very substantial undeveloped deposit, Reunion, uh, by a company that has a reputation as a mine builder and a mine finder. The acquirer was a single asset producer, and the acquired company would have been a single asset producer, despite the fact that the acquirer had to issue an awful lot of stock to buy the target. The combined valuation went up because you eliminate the single asset producer discount. Similarly, the acquisition of Centamin by Anglo was all about the same thing. Thus far, the M&A has occurred around quality assets, but the incredible discount in the market between single asset producers and multiple asset producers means that this M&A trend is going to continue, and it will come down into lower quality projects.
Are there any mines you think that will get funding in the next 6, 12, 18 months that you think have not gotten funding yet that you think are like a slam dunk?
I don't know about a slam dunk. I think anything that you see, absent a real decline in the gold price, that gets permitted and funded will do well. Lobo Tigre has pointed out with his golden runway thesis that through good markets and bad for the last 20 years, the period between shovel ready, which is to say permitted and financed with a positive construction decision, and the attainment of nameplate feasibility, that is, during the construction development period, uh, those companies have performed very well in the markets. The exit from the Lassonde curve, the permitting and financing challenges into the phase where that's been accomplished, has been for 2 decades now a real sweet spot in mineral equities markets. And I would suggest to you that isn't about to change in the next 2 years. So I suspect that any company that gets its way through a positive feasibility study, and I want to say companies that are built with, not without feasibility studies, that have been permitted and financed, I think in the next 2 years will do well.
Do you think that Mexico is still safe for a mining company to make a sizable investment in a copper, gold, and silver mine, or are you still worried about what's happened after their most recent elections?
I'm less worried than I was 6 months ago. What the president has said is that she will look much more closely at the community's assessment of the risks and the benefit to mining. That she will not, as an example, ban all open pits if the community where the proposed open pit is to be constructed is in favor of it. And if all elements of the Mexican mining code, including uh, the export of deleterious material, which is to say pollution from the mine site, has been addressed. The truth of Mexico is that in certain regions of Mexico, in particular, uh, the Silver Belt is an example, or in the very north, the Laramide, is that the only development opportunity available for much of rural Mexico is mining. It's also true that the Mine Workers Union has traditionally been an important source of votes for the party in power.
Okay, so the worries for our listeners out there who don't remember what happened with Mexico, what, 8, 9, 10 months ago, they were talking about potentially banning what, open pit heap leaching, but you're saying that that's overblown for now, at least.
I don't think that the risk is gone. I think it's incumbent on mining companies to work very closely with the local community. The new president has indicated a willingness for a more equitable sharing of the social benefit from mining. Traditionally, in many countries, the joke goes the capital gets the rent, the region gets the shaft. And
So
what that
government
means,
royalty taxes go up then, right? Because the gold price has
correct.
gone up. So they see that the gold price, oh, okay, they can't move the mine. The gold price has gone what from 1800 to 2600 in the last like 12 months. So they're going to see the government's like, oh, we need to raise the royalty tax.
Well, what she says is that she favors a more equitable distribution of the social rents so that not all of the royalty and tax goes to Mexico City, but that more of the money generated from the social take on mining stays in the communities. If
Okay.
that's true, local favor in the community should be much stronger. One of the difficulties we've seen, particularly in Latin America, in Peru, and more particularly in Guatemala, is that the taxes and royalties from mining didn't go to the affected communities. They merely bore the cost of increased infrastructure, increased utilization, without getting any social benefits, which is to say, schools didn't get built, hospitals didn't get built, roads didn't get built, despite all of this economic activity. The regions didn't see the benefit. The center did.
Oh, I
The
thought the mining company is in charge of building the local infrastructure like that, but you're saying then that the central government, say the capital Peru or these other Latin American countries, you're saying that the tax revenues would all go there from the mining company, the royalty taxes, and then what the money would be stolen or the money would be invested in what local infrastructure in the capital city?
well, traditionally the money has gone to the center. What they do with the money is a different uh, uh,
Yeah.
It's a different issue, but there can be no doubt if you have traveled to emerging and frontier markets, mine sites as long as I have, that the regions that generate the wealth have seen very little of it. It is true that mining companies, often out of self defense or out of a sense of social justice, will do things like build hospitals and clinics, improve roads, improve power distributions, build schools, fund soccer teams. The mining businesses have done that. Traditionally, uh, when host governments talk to the mining companies, they'll say that sufficient social rent needs to be charged to build the infrastructure that assists you in the region. They take the rents and they don't build the infrastructure.
Well, unfortunately, this is the nature of government. There's just tons and tons of corruptions. They say one thing and they do another. There's a lot of greedy, selfish people that claim to be socialists running a lot of these governments. They're just really hypocrites. Look at the trust fund baby kids of like Hugo Chavez and Maduro. They're all posting like flying on private jets and expensive vacations from all the money that's been stolen out of Venezuela.
Well, think about this too. Think of the temptation as the president of Mexico. If you enjoy, let's say, $1 billion worth of taxes and rents from mines in two or three states, and those states house 30 million people, but you need to get elected in a nation with 100 million people. Your temptation will be to transfer benefits from the region that generates the wealth to other regions that generate votes. That's just the way things work. Elections are always and everywhere advanced auctions of stolen property. So the government needs to juxtapose equity, which is to say, more money to the regions that generated the wealth, with reality, the distribution of benefits in politically expedient domestic spending programs.
So I want to ask you about a success story, it sounds like, for mining in Argentina. Now, Malay has said that there's going to be a tax break over the next, 4 or 5 years, and some type of fast track program where if a mining company commits to building a project, that they get a tax break if they make the investment in the next couple of years, they don't have to pay taxes on it.
I don't think that's what he said. What I think he said is that mining companies will be exempt from GST on goods and services that they import to do major developments, thus far defined colloquial as developments over $1 billion. But more importantly, that he will fast track permitting and he will sign fiscal stability agreements so that to the extent, as an example, that you build a copper mine in Argentina and you sell the product, the copper, for US dollars, you will be able to take those US dollars out of Argentina. In other words, you will be able to repatriate the money. And a circumstance where your fiscal agreement, your royalties, your offsite capital contributions, and your taxes will be fixed for a certain period of time. That's brand new.
Is that a lot better?
Traditionally,
Is that
Argentina has been where money goes to die. You invest in Argentina, you develop a significant operation, and then you can't retrieve your money.
or they have to set up like an offshore, a foreign currency vehicle, right? They had to set up an LLC or something like that because there was weird currency trading stuff. There was a lot of the tax complications with a mining company in Argentina over the last 15 years just sound like way too much of a hassle.
Jason, I was once a partner in a private oil company in Argentina, and it was pretty successful. We got up to producing about 1,400 barrels a day, and our operating margins, due to the skill of our local staff and the geology in place in the Neuquén Basin, were frankly astounding. And what we had to do to make this work, we couldn't take capital out of Argentina. So, one permitted activity was that as an oil company, we could buy shares of YPF. So, we would use our operating cash flow in pesos to buy shares of YPF, and we would courier those shares across the border into Uruguay, across the river, and sell those shares in Uruguay. And then we would transfer the money from Uruguay to Calgary, and we would pay our local bills from Calgary. Um, Eventually, this became too much brain strain, and we just basically sold the business. But the complexity for a foreign investor in Argentina for 80 years has been mind numbing. And if Melee is actually able to show the industry that they'll have a 30-year holiday from idiocy, a 20 or 30-year holiday from idiocy, there's probably $50 billion worth of projects that could get permitted and have construction start in Argentina in the next 5 years. Uh, the biggest problem that Melee faces right now is that the peso is overvalued and there's a shortage of foreign exchange. If you permitted and began construction on $50 billion worth of projects in Argentina, the foreign currency problem would be absolutely over.
Well, also, it would create a lot of jobs for the local domestic economy, and then
Correct.
people, you'd have foreign direct investment, and you'd start to build up some infrastructure around the mines and nice towns, and then the overall education and the savings, the capital accumulation for those local mining towns over time and generation, that would start to improve too.
And Jason, the human resources in Argentina are spectacular. There are a lot of Argentines employed in the mining, oil and gas business and finance businesses outside Argentina that would love to go home. And the ability that we have as foreigners to employ good people in Argentina, the levels of literacy are high. In my experience, the work ethic is good. Um, all that stands between Argentina and prosperity is the Argentines' genuine desire to allow it.
They have some great projects too. I mean, Glencore has the Mara project. That's a massive polymetallic, base metal mine with some gold
It is.
byproduct.
It is. The Vaca Muerte, which is their shale package, has been described as, in many senses, superior to the Permian and Delaware basins in the U.S. It's been about 7% explored. That's a major project. The drilling densities that we've seen in West Texas haven't been attempted in Argentina, nor is the gathering and processing infrastructure installed. So you're talking there in the Vaca Muerte by itself, a 25 to $30 billion opportunity. And then, of course, there's the opportunity, not quite ready to go yet, of the Vicuña copper gold project uh, in northwestern Argentina, the astonishing discovery made by the Lundin Group of companies that probably will rank as one of the 10 most profound copper gold discoveries in the last 100 years.
Is that
Uh,
where Caserones is, or is that and
Correct.
Jose Maria? So that's all in the same area right around there?
Correct. Caserones being on the Chilean side of the equation, Jose Maria being on the Argentine side, but it's the same transverse structure, the same structure that cuts east-west across the Andes from Chile uh, into Argentina.
And of course, we've talked about this in past interviews. You also have arguably the world's top undeveloped silver mine there, La Navidad, which is around 500 million ounces of high grade silver.
Yeah, there you have a separate problem. Um, there, the problem is local, provincial caciques, politicians who have, for their own purposes, opposed development. If the election of Melee is a symbol of the fact that people want to defang the political class in favor of economic development, certainly Melee would be uh, somebody who would be in favor of that project at a national scale. But approval for that project has to include Santa Cruz, the local domicile, where the political leadership has been unalterably opposed to the project. I suspect, I have no evidence for this, but I suspect in an effort at rent seeking.
So I want to ask you now a big picture question about capital expenditure for other industries affecting energy demand, copper demand, nuclear power, uranium, and commodities demand overall. So the large technology companies, Rick, so Apple, Google, Microsoft, OpenAI, some of the other XAI, Elon Musk's competitor to OpenAI, XAI, they're building these absolutely massive data centers. They either started construction or about to start construction. The Colossus data center is the largest one in the world. There's these other data centers. I think Meta just ordered 20 new data centers. They're about to start construction. Do you think that this is a new demand side increase for energy, for copper, that the market is not anticipating, that this is a really powerful long-term trend?
I think that the market is anticipating this, and I think people like you and me are excited by it because it affects us. What the market isn't paying attention to is something much more basic. It's a billion people on Earth who have no access to primary electricity. Data centers don't yet impact people in Malawi, but the resources boom that we experienced in the decade of 2000 to 2010 occurred without data centers. It occurred as a consequence of the urbanization of China, the moving of 500 million people from dire poverty to being merely poor. There's 2.5 billion people to go. The primary driver for industrial materials, the primary driver for energy, isn't data centers. It's 1 billion people on Earth who have no access to primary electricity, and 2 billion people on Earth who have access to only intermittent or unaffordable electricity. Amazingly, as big as the data center story is, it's merely the icing on the cake, except in one place, which is nuclear power. What the data center demand is all about is non-interruptible, very high quality, 24/7 power. In addition to that, because the power user is very wealthy and can afford to pay, quote, too much for power, they want carbon-free power. In other words, Microsoft has absolutely no interest in wind or solar because it's not 24-hour power. They also have no interest in coal. The power source that is of primary interest to the technology community in AI centers is nuclear. Hence the proposal, and you could have knocked me over with a feather when this happened, Jason, to restart 3 Mile Island, the poster child for the demise of the nuclear industry in the United States, and restart it with a data center housed within its walls. This is absolutely astonishing for me. And for the North American and European nuclear power industry, perhaps for the Japanese nuclear power industry, this is a real, true game changer. What was particularly attractive to me when I heard about 3 Mile Island is the fact that the data center was willing to buy uninterruptible, 24/7 priority access, non-carbon generating power for 80% above the going rate for power in that jurisdiction. In other words, it wasn't merely that they wanted the highest quality possible power in very, very, very large quantities and had the balance sheet to pay for it. It's that they were willing to pay an 80% premium to market to fulfill those demands. That's astonishing.
Well, the data center build out is insane. Like the average person maybe hasn't watched any presentations from the NVIDIA CEO. I mean, each one of these racks with the GPU units on them, the new Blackwell ones that NVIDIA's producing as fast as they can, each one of these racks weighs 3,000 pounds, and they have to supercool it. So that's like an absolutely insane amount of energy. I think the point that you made, Rick, about reliability for energy, this is why you can't have solar and wind full time on it. Yeah, maybe when during the day you can run some supplementals and put some solar panels on. But if these data centers go down, the artificial intelligence software programs that are running, they're wasted. They're useless.
That's correct. They want the highest quality power. They don't want power from a grid because they know that the voters will shut them off in favor of home heating. So they want primary power. They want power that's dedicated to them before it's dedicated to the grid. They want it 24/7, and they want it non carbon generating. There's only one way to do that. There's only one way to do it. It's nuclear.
Well, over time, isn't nuclear cheaper though? So maybe up front, like you said, nuclear is more expensive, but over a longer period of time, nuclear is going to end up being cheaper, over amortized over what longer kilowatt hours. I think isn't nuclear the cheapest over the very, very long term?
That's a function of regulation. The Chinese can build a new gigawatt nuclear power plant for about 7 billion US dollars. It takes $30 billion to build that plant in the US. If you amortize the power produced over $30 billion in the US and over a 20-year permitting period, no, nuclear isn't the cheapest power. If you do it the Chinese way, which is to say, if you permit it by Wednesday and you build the plant for $7 billion, then the answer to that is yes.
What other commodities do you think will benefit from this data center build out, all the capital expenditure that the big tech companies, OpenAI, XAI, some of the others, is it going to be copper? Is it going to be natural gas? Is there a commodity that people are missing that is going to benefit from increased demand and from the data centers?
Copper, yes. Cobalt, yes. I suspect if it occurs, frankly, that the scariest beneficiary to the upside would be heavy rare earths. We've seen increases in rare earth demand as a consequence of a whole bunch of technological applications. But distributed power around batteries and the utilization of this power in data center demand is has a lot to do with micromagnets. And that's all about rare earths. So my suspicion is that if this build out occurs, the part of the mining industry that hasn't been adequately addressed is rare earths. Now, note that rare earths are misnamed. They're not rare. We haven't looked for them because the Chinese produced them so cheaply. But if demand increases as rapidly as you suggest it might, Jason, as a consequence of these data centers, and if rare earths ends up being a point of geopolitical strife between China and the West, the stealth beneficiary, the dark horse that you asked me to talk about, could well be rare earths.
I think that's a good point there. I think that's why Trump is trying to negotiate with Greenland. So I don't know if they're going to buy it or annex it, but if they do a trade deal with Greenland, I mean, Greenland has a massive rare earth element reserve there that's
Yeah, but
undeveloped.
they're lousy rare earths, to be honest with you. If that's why Trump's doing it, uh, he's using a formerly illegal substance.
Oh, that's interesting. I mean, they had like a large amount of reserves there, but they don't have a lot of infrastructure there because I don't think they don't have that many people. They don't do a lot of oil and natural gas mining around there or mining around there. It's just it's very underdeveloped in Greenland. I actually think for Dark Horse, I'm going to say natural gas. I'm thinking like the U.S. is going to be exporting a lot of liquefied natural gas to Europe and Asia because they're not going to be buying from Russia. A lot of people are looking for cleaner burning compared to coal. And then these data centers, I think like it's going to be easier, Rick, especially with a Republican Congress and Trump in the White House, to get a pipeline, a natural gas pipeline from the Marcellus and Utica shale down here in Northern Virginia to start building pipelines for EQT. And that's a bunch of extra natural gas that can be used for the data centers.
I think that the natural gas business will do very well, but I don't think that data center demand will be that extraordinary, except perhaps in California, where the voter mandate is to increase the utilization of solar and wind, and where you need natural gas as a source of peaking fuel when the sun doesn't shine and the wind doesn't blow. I think that natural gas will do well simply because it's cheap. The BTU price disparity between oil and gas is at historic highs. Meanwhile, utilizing natural gas cuts the carbon output from fossil fuels by 50%. I think those two things, the low price of natural gas and its utility relative to its carbon generation, means that natural gas will do extremely well. You had asked me to quantify natural gas demand as a function of data centers. And I don't think that natural gas will be as an important a component of data center powering as nuclear will. But I certainly agree with you that natural gas will do well. Natural gas will also do well because although the Biden administration didn't put in place an awful lot of new regulation that was hostile to natural gas, at the same point in time, there were cultural or de facto objection to the increase of natural gas infrastructure, LNG plants, gas gathering systems, gas storage systems, gas transmission systems. And my suspicion is that the non regulatory objection to natural gas infrastructure expansion in the US is over for the next 4 years. And that'll be extremely beneficial.
Well, some of the data centers that are recently just finished with construction, they have focused on natural gas more than nuclear, but I think they're going to need all of the energy investment that they
Agreed.
can get. Hmm?
Agreed. And understand that to the extent that the resurgence in nuclear generation in the United States and Canada is gobbled up by the data centers who are willing to pay 80% premiums for uninterruptible power. What that means is that the normal and natural growth in power demand in the United States will need to be met by other substances. And it would seem that the United States is on a mission to completely obviate coal power generation. The most likely beneficiary of that conversion is gas. And despite the fact that we haven't built new coal plants for a long time, coal is still generating an awful lot of U.S. baseload demand. And it would appear that we don't have very many alternatives to replacing that coal-fired baseload power other than on the one side nuclear and on the peaking side natural gas. Natural gas, I think, will be an enormous beneficiary of that. But natural gas is also, I think, a beneficiary of the fact that it sells on an energy equivalent basis at an extraordinary discount to oil. And I think that for non-transportation purposes, that differential at least lessens because natural gas generates an awful lot less carbon output than oil does.
Well, but you still have record coal demand for coal-fired electricity from what China, India, other parts of Asia. So they're not like adhering to the Paris Climate Accords. They've been buying coal and using it for electricity generation a lot the last couple of years.
Well, that's an interesting point, and let's talk about that. Emerging markets countries, when they uh, look at these climate accords, point out something that's very inconvenient to Western politicians. The Chinese and the Indians and other emerging markets countries say that carbon output shouldn't be measured by nation. It should be measured per capita. uh, Western rich people are much greater users of energy per capita than emerging markets people are. And the emerging markets people say that they have an energy budget that's a quarter of developed countries' energy budget. They say further that if we're concerned about new carbon loadings into an atmosphere that is already, according to the West, overcharged with carbon, that the West has to pay a penalty for the carbon that they have already put in the atmosphere. That historically, frontier markets, including India and China, have put in very little of the existing carbon that Western politicians say is the problem. So if we're going to address carbon loadings and global warming equitably, all of the cost has to be borne by the West. If you want to see what that looks like, it looks like Germany. It looks like intermittent power with your electricity bill, with your power bill increasing by 500%.
Which
Now,
destroyed their economy.
I
Destroyed their
want to hear
economy.
Angela Merkel and Justin Trudeau and Donald Trump or Joe Biden, whoever you like, saying to the voters, yes, we are going to address our carbon goals by 2050. And as a consequence of that, your power will become less reliable, like Germany. You will have more blackouts and brownouts. And oh, by the way, your power bills are going to increase by 500%. I'd love to hear Western politicians tell the truth and see how attractive that was to the voters. What you describe, the increases in coal demand in frontier and emerging markets, is very true. And rather than vilify them for that, we need to understand that their carbon output historically has been much less than ours, and that carbon outputs, if we look at it as a planet, need to be done per capita, not per nation.
Well, they also have exemptions from the Paris Climate Accords, and they've used what they were dumping landfills of our trash and stuff like that in China and Africa for many years. So
Yep.
the landfills were there. So I mean, like you brought up rare earth mining. I mean, like China, the only reason China was the low cost rare earth miner is they did it irresponsibly to mine the rare earths and separate out. I mean, the air, water, and soil around the rare earths mine to mine the rare earths because they're radioactive and they're toxic with the chemicals and into in the value chain, like they've made a giant mess of things all around the rare earth mine. It's toxic and radioactive around there with the air, water,
And
and soil.
perhaps we can talk about rare earths next time. I need to say I need to jump off this call in 2 minutes, so we need to wrap up.
Okay, well, we'll definitely talk next time. I wanted to ask you about royalty and streaming companies. I mean, at the current prices, they're generating a lot of free cash flow. I think there's good value there.
I agree. I
Thank,
absolutely agree.
well, I want to thank you so much for your time today, Rick. If my listeners want to check out Rule Investment Media or follow you on social media, how do they do so?
Well, the best thing to do is Rule Investment Media. Come to my site, list your natural resource stocks. Go to ruleinvestmentmedia.com, list your natural resource stocks for no charge, for no obligation. I'll personally rank them 1 to 10, 1 being best, 10 being worst. If I have comments worth commenting on individual issues, I will do so. Rule Investment Media, list your natural resource stocks. Please no crypto, please no pot stocks, please no tech stocks, just natural resource stocks. Jason, I enjoyed the conversation. I'm sorry I got to go, but thank you for having me on.